Hello, guys. This is episode number 9, part 2. Okay. So here we're going to discuss correlations in Forex and CFDs market. And we will also discuss about risk on and risk off environments. First, let's complete this risk on, risk off environments. It's much easier to grasp. Okay. So risk on environment. In the risk on environment, investors are willing to take more risk, leading to higher demand for riskier assets such as stocks and commodities. In the risk of events or the environment, investors seek safe haven assets such as government bonds, gold, due to heightened uncertainty or market turmoil. Okay, recognizing risk on and risk off environments help traders to adjust their strategies accordingly and navigate market sentiment shifts. Okay, so let me share a whiteboard here. Okay, in risk on environment, okay, the traders or investors take more risk. And trade in riskier assets such as stocks and commodities. Okay, and in risk of environment, traders take less and calculated risks. By investing or trading in safer assets such as gold and government bonds. All right. So this risk on environment is when the volatility is high. Sorry, when the volatility is low. So when the volatility is low, the trader take more risk and trade in risky assets such as stocks and gold. And risk of environment occurs when the volatility in the market is low. Let me give you an example. Like in the normal days, okay, in the normal days when the volatility is low, then the trader employs risk on environment. And in the geopolitical turmoils, okay, when the volatility in the market is high, then the trader employs risk of environment. When is the volatility high, or what are the examples of the geopolitical environments? For example, when Israel attacked Gaza, okay? The second example is Russia attacked Ukraine, okay? Or events like Brexit. So Brexit is the event when the UK or the United Kingdom decided to exit from the European Union, EU. So that event was known as a Brexit. So in these kind of events, when there is a geopolitical turmoil, then the trader or investor trade in the risk of environment, okay, because the volatility in the market is very high. Okay, they cannot take a lot of risk. They just take limited risk, okay, and they just take the calculated risk. All right. Another example of geopolitical turmoil events or the risk of environment is when during market crash of 2008 or 2000. Okay. During the 2008 financial crisis or during the 1998 to 2000 dot-com bubble financial crisis or the market crash, okay, the volatility in the market increases a lot. So the traders at that time were employing the risk of events. And the other one is also very famous, which is coronavirus pandemic. So coronavirus pandemic, this is another example of risk of events, sorry, geopolitical turmoils when the traders employ the risk of events. Normal days are just like the days now, okay, or any usual day when there is no geopolitical turmoil occurring around the world. Okay, those are the normal days. During those days, the traders are willing to take more risk and they trade in the risky assets such as stocks and commodities. Okay, so I hope everything is clear about risk on environment and risk of environment. Okay, and now we're gonna come to the correlations in the Forex and CFDs market. Correlations measure the relationship between different financial instruments. Positive correlation means when the two assets move in the same direction. Negative correlation means when the two assets move in the different direction. No correlation means when a non-directional relationship exists between two assets. Okay, understanding the correlation help traders diversify their portfolios and manage risk effectively. So let me show you here about correlation. Okay, let's suppose we have GBP slash US dollar, and the other asset class is Euro US dollar. And both of these assets, they are moving in the same direction. Either they are going up or either they are going down. So they both are moving in the same direction. We call this as positive correlation. All right. When the both assets are going in the same direction, either up or down, this is also positive correlation. Correlation. Okay. All right. So let's consider another example. Here we got GBP USD and here we got USD JPY. Okay. Now you can see now let's consider an example of GBP USD and USD JPY. Here in the example, GBP USD is going up. Meanwhile, USD JPY is falling. I also showed you on the screen. Okay, GBP USD is USD JPY is falling, and GBP USD is going up. This type of correlation is known as, okay, I also show you here, right? Okay, on the screen. Like here, GBP USD is going up, and here USD JPY is going down. This type of correlation is known as negative correlation. Okay, negative correlation. Okay, this is known as negative correlation. When the two assets are moving in opposite directions, then we have a negative correlation. When the GBP USD goes up, then the USD JPY goes down. When the GBP USD goes down, then USD JPY goes up. This is known as negative correlation when two assets are moving in different directions. Okay, that's it. Negative correlation. So you're clear about the positive correlation and the negative correlation. Then there are another example. For example, we have Euro GBP, and the other asset is USD JPY. Okay, here let's suppose that Euro GBP is going up, okay, and USD JPY is moving in a range. Okay, so there is no directional bias here. There is no relationship between USD and JPY. And when Euro GBP is going down, again, USD JPY is moving in a range. When such correlation, okay, in here we don't have any correlation. When the two asset classes have no relationship, have no directional relationship, we call those assets as no correlation. There is no correlation or zero correlation. Okay. All right. So here is a fixed time here. Okay. Let's suppose we have a here 0, +1, and here we have -1. So when the correlation between two assets, it's at this point, we call it as negative correlation. At this point, or between 0 or 1, between 0 or -1 or at -1, we call this as negative correlation. Okay. This one, if the correlation index is at 0, we call it as 0, no correlation, or 0 correlation. If the correlation index is between 0 and +1 or at +1, we call this as positive correlation. Okay, very simple to understand. I hope you have got the point about negative and positive correlations, and even the zero or even the no correlation or zero correlation. Okay, let me show you the positive correlation on chart. Let's suppose this is here, the GBP USD is moving upwards and USD JPY is moving downwards. This is known as a negative correlation. Now compare GBP USD with Euro USD. So GBP USD is going upward and Euro USD is also going upward. So this is positive correlation. Now comparing GBP USD with, let me add more, AUD JPY. Okay, now GBP USD, you can see it's going up. AUD JPY is also going up, but there is no correlation here. Okay, there is no correlation here. There is a centralized correlation here, but in conceptually, there is no correlation that exists between GBP USD and AUD JPY. Okay, now you can see that USD JPY is going down, AUD JPY is going up. There is a negative correlation here. Okay, so as a simple fact, okay, as now this is the ideal situation. Okay, what I'm going to cover here is the ideal situation here. Now, case one. Okay, if the base currency of two currency pairs are the same, then there will be a positive correlation. For example, USD CAD and USD JPY. Here, USD and USD both have the same base currency. So they will have a positive correlation. Case 2, if the code currency of two currencies are same, then there will be a positive correlation. For example, GBP USD and Euro USD. Here, the USD is a code currency in GBP USD, and USD here is also a code currency in Euro USD. So they both are positively correlated. In the same way, okay. Now the third case is if the base currency of one currency is a code currency of another pair, then there will be a negative correlation. If the base currency of one currency pair is the code currency of another currency pair, then there will be a negative correlation. For example, USD JPY. Here the USD is the base currency, and here the USD is the code currency. When this type of situation occurs, then there will be a negative correlation. Okay. All right. Case 4. If the code currency of one currency is a base currency of another currency pair, then there will also be a negative correlation. For example, GBP USD and USD JPY. Here, USD is the code currency in GBP USD. Here, the USD is the base currency of the USD JPY. In such situation, okay, when the base currency, when the base currency, when the code currency of one asset is the base currency of another asset, then there will be a negative correlation. Okay, let me give you a very, very small context. When base of one pair is equals to base of another pair, or quote of one pair is equals to quote of another pair, then in such situation, what we're gonna have? We're gonna have a positive correlation. Okay. All right. In the same way, when base of one pair is equals to quote of another pair, or when quote of one pair is equals to base of another pair, then in such situation, we're gonna have a negative correlation. Okay, that's what this document explains. All right, now case 5. If both base currencies and code currencies of two currency pairs are different, then there will be no correlation or zero correlation. For example, Euro USD and GBP JPY. You can see that in Euro USD and GBP JPY, in Euro USD and GBP JPY, there is there is no match of base or code currencies. Okay, so hence there will be no correlation. Okay, so we go to the white code. Or code currency of one pair does not match with base or code currency of another pair, then if base currency of one pair, if base or code currency of one pair does not match with base or code currency of another pair, then we will have zero correlation. Okay, that's it. So I hope you got the entire idea about base and code relation, base and code. Sorry, about the positive, negative, and zero correlation. This is the end of this video, and I'm gonna see you in the next episodes. Okay. So this is the end of the episode 9. This is basically episode 9, part 2.